When it comes to wealth preservation and growth, the world's richest individuals have access to investment opportunities and strategies that often remain out of reach for the average person. These methods aren't just about putting money to work. They're about leveraging access, expertise, and innovation to both protect assets and generate outsized returns, even when markets are uncertain. But what's truly fascinating is that, even among the wealthy, some of the most effective strategies are kept quietly under the radar, hidden not only from the public, but from many affluent investors themselves. Today, we'll uncover one of the most powerful, yet discreet investment strategies that even the wealthy tend to keep under wraps: the strategic use of private credit and alternative investments. In recent years, the investment landscape has undergone a significant transformation. Private credit, once the exclusive domain of institutional investors and ultra-high net worth individuals, is experiencing a democratization driven by technology and innovation. Where entry to this asset class once demanded millions in capital and connections to elite networks, new products and platforms have emerged that lower the minimum investment threshold to as little as $1,000. This shift has made private credit more accessible than ever before, yet it remains relatively obscure compared to public stocks and bonds. So, what exactly is private credit? At its core, private credit refers to loans and debt investments that are not issued or traded on public markets. Instead, these are direct loans made to companies, real estate projects, or even individuals, often structured to meet specific needs that traditional banks might not serve. Private credit funds pool capital from investors and lend it out, earning returns through interest payments and, in some cases, equity kickers or profit participation. The appeal is clear: higher yields than public fixed income, customized risk profiles, and a degree of insulation from public market volatility. Over the past 3 years, high net worth individuals have surged into private credit, increasing their holdings in this asset class by 2.5 times. Today, their investments make up roughly 12% of the private credit assets managed by leading firms, a testament to its growing importance in sophisticated portfolios. The reasons for this shift are both practical and strategic. In a world of low interest rates and unpredictable equities, private credit offers attractive, risk-adjusted returns. Its illiquid nature, once a barrier, now acts as a feature, providing stability and reducing the urge for panic selling during market swings. But private credit is only one part of the story. The ultra-wealthy have long understood the value of alternative investments, assets that go beyond conventional stocks and bonds. This includes real estate, hedge funds, private equity, venture capital, and private debt. These alternatives offer not only the potential for outsized gains, but also diversification benefits. They often behave differently from traditional assets, acting as hedges against inflation, political turmoil, or market downturns. Recent regulatory changes are beginning to open the door for these alternatives to be included in vehicles like 401k plans, hinting at a future where everyday investors might one day enjoy the same advantages. Yet alternatives come with complexity. They often require higher minimum investments, carry unique tax implications, and demand a level of due diligence that far exceeds what's required for buying a share of a blue-chip stock. For this reason, the wealthy surround themselves with specialized advisors and constantly educate themselves, ensuring that each investment aligns with their broader goals, whether that's capital preservation, legacy planning, or aggressive growth. One particularly underappreciated alternative is tangible assets. Fine art, rare collectibles, luxury goods, and even vintage cars. For the ultra-wealthy, these aren't just tokens of status. They're strategic holdings that can appreciate over time, provide diversification, and in some cases, deliver powerful tax advantages. High-quality art, for example, has seen impressive long-term returns, often outperforming traditional markets during periods of high inflation or economic uncertainty. In certain jurisdictions, art can also be donated to charitable foundations for substantial tax deductions, turning passion into a potent financial tool. But perhaps the most quietly powerful strategy employed by the wealthy is the use of leverage, what's often called other people's money. This isn't just about borrowing to invest. It's about structuring deals where the risk is managed and returns are magnified. In real estate, for instance, a savvy investor might use a mortgage to acquire a multi-million-dollar property with only a fraction of the purchase price in cash. The property then generates rental income and appreciates in value, while the investor's actual capital at risk remains relatively modest. This approach isn't limited to real estate. It's a cornerstone of private equity, venture capital, and even some alternative lending strategies. The essence of this approach is control. The wealthy don't just invest. They negotiate, structure, and sometimes even create the investment itself. By leveraging relationships, expertise, and tailored financing, they access opportunities that would be impossible for the average investor. It's not just about what you own, but how you own it, and crucially, how you finance it. There's a reason these strategies remain under wraps. They require more than just money. They demand access to information, networks of trusted partners, and a tolerance for complexity that goes well beyond what's required for conventional investing. The rewards, however, can be profound. Private credit, for instance, has delivered attractive returns even as public bond yields have languished. Alternatives like hedge funds and private equity have outperformed traditional portfolios, especially during periods of market turbulence. Tangible assets have preserved wealth and provided liquidity in times of crisis. And leverage, when used judiciously, has enabled investors to scale their wealth far faster than would otherwise be possible. What's changing now is the increased accessibility of these tools. With technology lowering barriers to entry and regulatory shifts enabling broader participation, the line between institutional and individual investor is beginning to blur. Platforms are emerging that allow accredited investors to participate in private credit deals, real estate syndications, and even fractional art ownership. Minimums are dropping, transparency is rising, and education is spreading. Yet, while the doors are opening, the most sophisticated strategies remain reserved for those with the knowledge, patience, and discipline to navigate their complexities. For those who aspire to emulate the strategies of the ultra-wealthy, several lessons stand out. First, diversification is more than a buzzword. It's about building a portfolio that can withstand shocks, generate consistent income, and offer upside in a variety of scenarios. This means looking beyond stocks and bonds and considering alternatives that may not be headline news but offer real, long-term value. Second, access matters. The best opportunities are often found in private markets, where information is less widely disseminated and competition is less intense. Building relationships, whether with fund managers, deal makers, or expert advisors, can unlock investments that aren't available to the general public. Third, structure is everything. The wealthy don't just buy assets, they think carefully about how those assets are held, financed, and taxed. They use trusts, partnerships, and legal entities to optimize returns, protect against liabilities, and plan for future generations. They understand that a well-structured deal can turn a good investment into a great one. Finally, education is non-negotiable. The world of private credit and alternatives is full of nuance. Risks can be higher, liquidity can be lower, and regulations can be complex. The wealthy invest heavily in learning, not just through formal education, but through experience, mentorship, and continuous engagement with the best minds in finance. In summary, while the public often focuses on flashy investments and market trends, the real secrets of the wealthy lie in strategies that are both sophisticated and, until recently, largely inaccessible. Private credit, alternative assets, and the judicious use of leverage form the backbone of portfolios that are built to last. These methods aren't just about making money, they're about building resilience, enhancing privacy, and creating a legacy that endures across generations. As technology and regulation continue to evolve, these once-hidden strategies are gradually becoming available to a wider circle of investors. But the true advantage will always lie with those who understand not just what to invest in, but how to invest. And just as importantly, why. By studying the methods of the world's most successful investors, anyone can begin to unlock the secrets that the wealthy have long kept under wraps. In this new era of democratized finance, opportunity is expanding, but it will always favor the informed, the diligent, and the bold.